What's going on, good people? Welcome back to another episode of Trading My Funded Account. Today is day number 27. It's November the 16th, 2023. We made some trades today, so let's get into it. So first and foremost, let's talk about all of the important levels that we have on the chart today. So we have yesterday's closing price, and that is at 35,050. That played a pretty important role today. And what's really interesting about today's session is the fact that during the pre-market hours, we traded in a 20-point range from around 3 o'clock this morning until 7 o'clock when that range broke out. So we traded in a 20-point range for 4 hours. Now that's different because usually in the pre-market, you'll see some type of move, either trending up or trending down. Sometimes it can be a combination of both, but it's very rare to just come in and see this type of tight consolidation during the pre-market hours. And what's really interesting about that is the fact that the market characteristics have kind of been changing over the past week or two. Because I remember during the week leading up to November 3rd, that Friday, we had on that specific week, we had the Fed meeting come out on Wednesday, and then we had non-farm payrolls come out on Friday. So that week was super volatile all week long, Monday through Friday. But then we came back the week after that, and it was kind of volatile, but not as much as it was the week before. And then as we got throughout that week, which was, I want to say, the week before last, once we got throughout that week, we pretty much didn't see too much volatility coming back into the market, and we saw a lot of range bound markets. And that continued to go into the week that was going on last week. And now we come into this week and we see the same characteristics starting to still be prevalent. That's telling us that the market is kind of taking a break. Now it's interesting really because if you look at the daily chart looks like the market is trending up, which it is. But a lot of that move does not happen in the New York session. And I just think that's something to keep track of because the overall market picture makes a big difference. Even though I trade on the 1 minute chart, the bigger time frames always matter. So I just wanted to point that out really quick because I think that's something interesting that we should keep track of as the course of the week goes along. Now, once we finally broke out of this zone, we established the range that we would trade in for the morning time session. Now, this was very interesting because look at how we had the zone up here, right? We had this 20-point zone. Now, once we broke out of that, we came back to establish a new but much larger range that came from that zone. So the range extended from this blue line down here at 34,950, and then it came back to a high of 35,030 right at the bottom of this consolidation zone. Now, what's really interesting right here is a concept called range expansion. So a lot of times you might get a range like this where the range is clearly defined. You can clearly see that we're trading in between 32 and 55. But what about this peak to the upside right here? Even though that's a false breakout, you still got to consider that as part of the zone or part of the range, whatever you want to call it, as well as these extensions past that consolidation area as well. All of those points make a difference because if the range ever decides to expand, meaning that the range no longer goes from 950 up to 35,030, let's call it 32. If the range no longer goes to that top level and turns around and it keeps pushing, well, where's it going to push up to? It's going to push up to that previous extreme level that got established earlier when the zone was already being created. Now, this is very tricky because you might actually start to think that, oh, okay, we had a shoot all the way down to the bottom of the zone or the bottom of the trading range. We had higher highs and higher lows on the way all the way back up. We broke past the original zone from the top layer, and then we continued to move higher. So you might think, oh, okay, the market has broken out, only to get sucked into a long position and then have the market pretty much throw up all of that up movement that it just made, create a lower high, and then come all the way back down to the bottom of the range. So that's why it's so important to understand ranges and understand zones, because it's not just as simple as going short at the top and then going long at the bottom. Zones can be very simple, but they can also be very complex. And today is a great example. So let's go ahead and talk about the trades that I made today. So before we go back to the screenshot, let's just define what the zone is represented by. So the overall trading range within this entire specific day, it ranged from 35,075 at its highest and then 34,950 at its lowest. So let's remember those prices as we go back to the screenshot. Okay, so let's talk about the trades that I made today. So we came in at 9:30 right here, and what's interesting right here is that the market opened almost at the bottom of the range, and as soon as it hit the bottom of the range, it wasted no time. It took one candle for it to turn around and move all the way back up to the top side of the range. So very interesting note right there. So let's look at number one. Now we do have these higher lows. This is my strategy right here, where I see the higher low and then see prices come back to retest it. But because it occurred in the first 10 minutes of the session, I just couldn't trade it. It looks so good and it looks so appealing. But as a trader, one of the things that's brought me into drawdown over the past like 2 weeks was the fact that I was just taking any trade just because it looked good. Now, in this specific scenario, I was like, look, my rules are my rules. I see the setup, but it's in the first 10 minutes, so I can't take it. So I felt good about that. You know, that gave me a little bit of confidence, because I'm like, okay, I'm not an emotional roller coaster. When I need to actually do the things that I need to, I have the ability to do so, as long as I focus and say, look, my rules are my rules. I'm not breaking them. So I'm proud about that. So then we saw prices just continue all the way back up to the top of the range after making 1, 2, 3, 4 higher lows. Okay, so that brings us to trade number one. Now, trade one is very interesting. So let me just give you the backstory about what I was thinking right here and what I was looking for. So whenever I'm trading a trading range, one of the things I look to do is either go short from the top or go long from the bottom. Now, when it comes to actually doing that, what I've really learned the hard way, was that you don't just want to short it because it's at the top of the range. You still want to look for some type of confirmation signal. So for me, that confirmation signal would be seeing the first lower high that gets formed inside of the trading range. If it's formed above the trading range, it doesn't count. It has to be formed inside of the trading range after a false breakout to the upside. So that's what I thought I saw right here, because prices came back, tested the top of the range right here at 35,070, sold off, came back into the original zone that we established from the pre-market. This is what these two green lines represent right here. That was that zone that we talked about, that 20-point zone. So I said, okay, it's back inside of the zone and it's back below yesterday's closing price. So I said, okay, more than likely we should make a higher low now that we've broken down below the zone after a false breakout. So I was just shorting right here on trade number one, expecting for this little candle right here to be a lower high. But what I ignored was the fact that the overall trend was still up. And yes, we did come to the top of the trading range, but you still don't want to go against price action just because you believe that the trading range is going to hold up. That's the idea that I had, but I still got to wait for confirmation to make sure that the market is giving me the signals that I need to say, okay, my idea is legit. Now I can place a trade behind that idea. And I think I jumped the 8-ball a little bit too early right here, because I saw this one candle not come up to make I guess a higher low, but I was reading it wrong, because look at how prices moved away from the top of this range. We had 1, 2, 3 candles that sold off to the downside. We never formed a lower high. So therefore, whenever we have a green candle that gets formed after this selling, no matter how many candles it was that pushed prices to the downside, this would still be a higher low if it hasn't come back to break the prior higher low. So this is a new higher low, even though the sell-off was very steep. The steep sell-off tells us that the buying is not as strong as it used to be, but it doesn't necessarily tell us that the buying is over. It just means that it's weaker than it was previously. So that's where I went wrong right here. I interpreted this as a lower high when in fact it was a higher low. And if you use the higher low strategy with this higher low that we're seeing right here, prices would have made the higher low right here at the circle. We draw a support line across, and then prices would have came back to retest them on this same candle that I shorted on. So in reality, I was reading it wrong and I should have went long. But you know, I learned my lesson, and the biggest lesson that I learned was wait for that confirmation and make sure you can distinguish the difference between higher lows and lower highs. That just comes down to attention to detail. Make sure you focus on every single part of the candle, the open, the close, the high, and the low, because they all matter and they all make a big difference. And one small mistake can lead to a bad trade, like trade number one. So that's what I learned right there. Just make sure you pay attention to detail. So then we come back and I take trade two right here. I went long here, right? And if you read the notes, it says going long at the support of the higher low is good. because that's pretty much what the higher low strategy entails. You wait for an uptrend. We had that. You wait for a higher low to get established. You had that. You look for support to be formed at that higher low. We had that. And then as soon as you see prices come back to retest that level, you go long and you look to take it up to the next level of resistance above, or whatever the next major place to get out will be. So I said, okay, I see the higher low and now it's time to go long. But if we continue reading the notes, it says even though going long at the support of the higher low is good, it's just not good from the top of a trading range. And that's the thing about it. When you're in a trading range, once you hit the top of it, you cannot think about going long. Well, I can't think about going long because I'm not a breakout trader. I've tried breakout trading. It's not for me. And I've learned that the hardest way. And today was another lesson. But I've learned over time that it's better for me to catch the move from the bottom of the range back up to the top and then just be happy with that and not expect for the breakout to occur, because breakouts and me just don't get along for whatever reason. So I went long right here at 2. But the thing was, you can't go long at the top of the trading range because now you're expecting the breakout. It's not that the breakout can't happen. It's just that if you're dependent on a breakout to make money on your long trade, you're really only giving yourself one option available to you in order to make that money, which is the market has the breakout. But let's say you bought lower, you didn't buy at the top of the range. You maybe, let's say we went long at this higher low. So for this higher low, you have multiple options of being able to make money. You can make money if this higher low held up and then continue to come back and retest the previous swing high, or you can make money if the prices came back to retest that swing high and then they broke out. So it's 2 different ways that you can make profits on that trade. As opposed to you buying it at a higher price, you now only give yourself one option, which is prices have to break out. Because if they don't break out, they'll come back into the range and stop you out, and it'll be a false breakout that you'll get caught up in. And that's exactly what happened at 2 right there. Now at 2, even though I kind of understood all of the things that I'm saying right now, I understood that we were at the top of a range, but I was like, okay, we were at the top of a range right here also, but we still created another higher low and continue pushing. So I'm like, well, if it's going to break out, then maybe this might be the time. But that goes back to just having enough discipline to say that no matter how appealing the setup might look, the rules always take precedent. If your rule is to never trade the breakout, then it doesn't matter how good the breakout looks, you got to avoid it. And right here, just to go back to my old point, I was just thinking, okay, well, we should get some type of bounce off of this wick right here to maybe at least just push us back up to the top of the range. So that's all I was looking for. I'm like, look, I know we're at the top of the trading range, so I don't expect a breakout per se, but I do expect us at least to come back and test it. But that's why I always say you trade what the market is telling you and not what you think. I thought that this wick would hold up, but clearly I thought wrong. And that's why you want to make sure that you avoid going long at those higher lows when they come near the top of a trading range, because that just decreases the probability of buyers coming in. Because think about it from a trader's perspective. All of the buyers that were long from 950, it was people that bought throughout the whole way up, and that's what price action is telling us. If you were in that trade and you saw that the major level of resistance was up here, maybe you might not sell when prices get there because maybe you're expecting the breakout. But what exactly would it be that would make you go long? It would be hard pressed to find any valid signals to tell you to go long, because you're saying, wow, the market has already moved about 120 points back up to the top of the range. I mean, how much further could it really go? So all of these people are not really that eager and excited to go long. And you can tell that that's the case because of the candles that you're seeing up here. We have 2 doji wicks in the middle, well, at the top of really 3 doji wicks, 1, 2, and 3 at the top of an uptrend, at the top of a trading range also. So that's telling us that whatever buying momentum occurred before is definitely dying down. And remember how we talked about how steep this pullback was? That was also a signal that the buying was dying down a little bit. And you combine both of these areas together, it's just too much information to tell you that, I would say it's too much information up there to go against the overall movement, which is buying is fizzling out. So that means that doesn't mean you go short right here, but you definitely don't go long. So that's pretty much all of the lessons that I learned from trade 2. And I would say the biggest one that I learned was, you're at the top of a trading range, don't take that higher low setup. Skip that one. So that's what I learned. So let's move on to trade number 3. Now, trade number 3, I started to get into the right idea. So on trade 1, I was way too early. Now trade 2, that just wasn't the best trade. But trade 3 really started to pick back up on the ideas that I have from trade number 1. I'm seeing that prices hit the top of the range and they came back into it. So I'm expecting for a lower high to get formed. And that's good. But you still got to wait for that lower high to actually get printed on the chart. Now right here, I shorted on trade number 3 as prices came back to retest the prior support level of the higher low that had been broken through. Because I'm like, all right, we had a double top at the top of the zone. We sold off. So we should be making a lower high fairly soon. And I'm expecting the lower high to get formed right here. But so you don't want to trade based on expectations. You want to trade based on what's already happened. And then you just react to that. Instead of trying to predict it, you just let it happen. And then you react instead of trying to be proactive. You be reactive. So that's what went wrong right here on trade number 3. Because if you look at where I entered and you look at where I stopped, where I got stopped out at, I got stopped out literally at the highs of the swing where I should have been going short from. Now, I came back on trade 4, and this was the trade that actually worked because I had everything in alignment already that I needed to see in order to get into the trade. So I had prices come back up, touch the top of the range, make a bearish reversal signal, which was the double top. And then we saw prices come back into the range. So that's signal number 3. We formed a double top, came back into the range, and then we made a lower high. So that's signal number 4. So once we see that lower high, I'm like, okay, now it makes sense to go short because the market is telling us what it wants to do. Remember what I said on yesterday's video about working through a drawdown? One of the most important points that I talked about was the fact that price action is not going to lie to you. Price action will tell you exactly where the market wants to move, and it's up to you as a trader to make sure that you're on the right side of the trade. So right here, price action did not lie. We had a double top, a lower high, and then prices continued down to the bottom of the range. So once I saw all of those things, I said, all right, cool. Now I can short that support level, what used to be the support level for that prior higher low from trade number 1, as prices come back up into that level. And that's pretty much what I did right here on trade 4. So if we read the notes, it says I shorted here after seeing a lower high at the top of the zone, and then I held this until I saw a bullish reversal signal. Now, normally I would go for my regular 20-point scalp target, but when I'm trading the range, my mindset changes a little bit because I've seen so many scenarios where I catch my 20 to 25 points inside of the range, but prices keep going down and they touch the extreme of the range eventually. So I've learned over time that if you short the range towards the top, no matter how much you feel like you should just take profits because you got a lot of profits, you got to hold that bad boy until it hits the bottom of the zone, unless you see a bullish reversal signal. And that's pretty much exactly what I saw once prices shot all the way down and hit support down here at 980. Notice that had been a prior higher low level before. So for us to see prices turn around right there, it shouldn't be surprising. So notice how once we hit that level, we bounced off of it immediately, very cleanly, came back, established this higher low. So I'm looking at the higher low and I'm saying, okay, I see it. Now, if they come back up and they come back to retest this level where if you follow it across, it used to be the bottom level of support for a prior zone from a prior higher low. If it comes back up to that level, I'll get out, especially if momentum stays strong like it did. So I ended up getting short at like 35,040 and took it back down to about 35,000. So still a 40-point trade, double my original scalp target that I usually look for, the 20 to 25 points. So very happy with that. I feel like I played that perfectly. Now, what's interesting is that prices do come back down to the bottom of the zone. But I'm proud of myself for just staying out of the move and not getting back in, because in order for me to get back in, even if I feel like I know exactly where the market is going, I still need to see my setup form in order for me to get into that trade and participate, because it just increases the chances of me having a profitable trade. Because not only do I have a feeling in my mind about where prices are really going, now I have confirmation because I see my setup starting to form and backing up the idea that I have. Now right here, we had a double top, 1 and 2, and we sold off and we broke past this prior higher low. but we never really came back to retest it. So I was waiting for that retest, and I was like, man, if I can get that retest, I'm doubling up on my contract size and I'm taking it back down to the bottom of the range so I can complete the trade that I made from trade 4. But it didn't work out that way, and I had an opportunity, I had a chance to chase the market down and just try and short because I knew where it was going. But I was like, Ty, you got to be disciplined. Maybe that will work for you in this scenario, but what if you take that mindset to other scenarios in the market in the future where it won't plan out that way for you, and you'll actually end up taking a loss? So how about we make the right decisions now so that it'll lead us and put us on a path to success going forward into the future, even though it looks like we could just get so much profit right now. Just hold off on it. If you don't see your setup, it doesn't matter where you think the market is going, you don't get in. So I did a good job on that, and I called it a day after that because I feel like I came in, I looked for the trade that was the best trade to take, and I took that. So what more could I ask for? I finished the day down by 2 points overall. So I took 1, 2, 3 full stop losses, and then trade number 4 was enough to pretty much make back all of that, take away the commissions, and I was down by 2 points. But to be down by 2 points after where I came from and where I started at the beginning of the day, I'm very happy for that, and I'm just trying to build my confidence back up to work my way out of this drawdown. So I felt like it makes sense to stop at a point where I feel like I'm good. I came in and I did what I was supposed to. So went ahead and called it a day, and I would say overall today I definitely learned a lot more about trading ranges, because from my experience, every trading range is some way, somehow a little bit different than the one that you traded before. There will be some similar common characteristics across all ranges, but most ranges has very specific price patterns and price action that you probably won't see get repeated in another range down the line. So you got to trade the ranges for what they are and not what you want them to be. And that's the biggest lesson that I learned today. And I hope you guys learned something about trading ranges also, because more than likely, this is probably something we'll probably see tomorrow and maybe extend it into next week, but we'll have to see how the future plays out. But that's all I got for you guys right now. I'll be back again tomorrow on November 17th, 2023, ready to finish off the week strong and ready to run it back. But until then, you guys, have a good one, study hard, and take it easy.